we have been given a second chance. The markets have bounced very hard from their lows, and this has given investors a powerful opportunity to de-risk their portfolio if they have the view that the Fed is going to continue running the economy into the ground. And that is what Michael Burry has done. He has sold all of his stocks. Definitely an extreme decision, but we're going to be talking about that today. That is the topic of today's video. Michael Burry has sold all of his stocks, and we're going to discuss, will he be right that we are going to enter the mother of all crashes? So in today's video, we'll talk about his latest grave warning. We'll talk about why he decided to sell his entire portfolio except for one company. I'm going to review some really valuable data for you. It's the Global Fund Manager Survey hosted by Bank of America. And this will show you how big money is thinking. And then we're going to talk about towards the end of the video, if there is a Fed pivot, where is that opportunity likely to be? And we'll do a quick recap of what we've been doing inside our community. Now, before we get started, make sure to follow me on my other social media on Instagram, because I post motivational content, life perspectives that I know that you will deeply enjoy. So links in my description below. And also follow me on Twitter because I'm pretty active on Twitter. And take a look at one of my recent tweets. I said that on August 16th, there are two camps. In the bearish camp, there's B of A, Morgan Stanley, BlackRock, Citi, Goldman, and we can add Michael Burry to this list. And in the bullish camp, we've got JPM, Credit Suisse, Deutsche Bank, Tom Lee from CNBC, Jim Cramer, Jeremy Siegel, and let's not forget Cathie Wood. So which camp will win long term? Well, follow me on Twitter, join the discussion. Always love to see your commentary, and make sure to be on my email list. I put a lot of effort into every single email that I write, and we can see here we got a lot of friends reading my content, upgrading their perspectives. I share philosophy from literature and historical events to make you a stronger investor. With that said, let's jump into the content. So Michael Burry, in 2008, he made this globally famous investment opinion. And what he did was he bet against the housing market. He bet against the subprime lending market. It was a very risky investment strategy where he persuaded Goldman Sachs to sell him credit default swaps, because every day that the value of the security doesn't go down, Michael Burry was actually losing money. So he was so confident in his housing crash opinion that he purchased lots of credit default swaps, and when the housing market did crash, Michael Burry made a personal fortune of over $100 million. And just as a quick refresher, Michael Burry has a very rigid investment style. He's much more on the conservative side when he looks at companies. He studies free cash flow, he studies enterprise value, he ignores the traditional earnings multiples. And that has led him to make some extraordinary calls over the last 18 months where he got very bearish on ARK, Tesla, Bitcoin in 2021. And in 2022, he shorted Apple. And now it was recently reported that he sold everything in his portfolio except for one company. And this company is related to prisons. Now, Michael Burry has a new warning for us. And it's this idea that the consumer is overly leveraged, and that will lead to tremendous problems down the road. Now, this was a very important decision that he made to sell all his holdings, because everything that he owned was relatively blue chip companies. They're not risky companies. They're blue chip, large cap companies. And in a latest tweet, an ominous tweet, Michael Burry tweeted, "Serenity now." And in terms of a translation, it means this is the calm before the storm. Now, the truth behind the real economy is not that upbeat. And I have to agree with Michael Burry here. We saw from Walmart's latest earnings, CEO of Walmart said that even wealthier families are shopping more at Walmart. So that surge that we saw in Walmart's stock after they reported earnings, it's because they've attracted a new customer base. And this new customer base is wealthy families who are trying to save money and therefore now shopping at Walmart. So I did a poll on my YouTube community tab, And 70% of my friends here have said that the economic outlook is rather weak. Now, I'd be curious to know who this wonderful 7% is. If that's you, make sure to put down in the comment below where you're from, because we'd all love to know. So the market's next big test is Jackson Hole. And this is an event where the Fed is going to talk about their balance sheet strategy going into this fall. Up until this point, the markets have been very focused on interest rates, the Fed funds rate. And I have to say, that is very important. But the elephant in the room is the balance sheet. And if you're following my channel, the one key takeaway that I have for you from today's video is you have to follow the Fed's balance sheet going forward. Whether the Fed raises by 50 basis points, 75 basis points, that is nowhere near as important as the size of their balance sheet direction. And I'm going to be helping all of our friends inside my investment community to navigate exactly what the Fed is thinking. So this is the new area that you need to focus on. It's not just 50 basis point hike, 75 basis point hike. That's not really an important catalyst for the market. So that's something that I'm going to be definitely paying attention to going forward. Now, since the Fed talked about reducing their balance sheet in May, quantitative tightening has only barely begun. And the bulk of QT, quantitative tightening, is slated to start in just a couple weeks, September. So Jackson Hole, this event I just talked about, is where the Fed is going to share their thinking on the trajectory of this balance sheet. Now, I want to share my initial opinion with you. And it's that if the Fed keeps their balance sheet relatively stable, like you see here, in other words, they're not very serious about reducing the assets on their balance sheet, I do think that the markets are going to be supported. However, if the Fed is going to reduce their balance sheet substantially, then just like I said a couple of videos ago, where the worst is yet to come, I'm going to say that one more time. The worst is yet to come if the Fed tightens their balance sheet significantly. That's something you want to pay attention to. I don't think interest rates alone will make stubbornly high inflation dramatically fall. There needs to be a stronger force to push down CPI. And that force is reducing the balance sheet. Now, I want to share with you the Global Fund Manager positioning data hosted by Bank of America, because this is going to help you understand how big money is thinking. So this is really valuable. Feel free to rewatch this part of the video several times if you need to. This is a very important part where you can understand how big money is thinking about the markets. So one of the major observations that I found from this report is the following. It's that a lot of institutional investors think that if a Fed pivot were to happen, it would only happen if core PCE inflation falls under 4%. So in other words, while retail investors like you and me were focusing on headline inflation, 9% 2 months ago, 8.5% just last month, the Fed is really focused on core PCE inflation. And big money is thinking that that threshold is 4%. And I will be covering this in future videos on my channel, so make sure to subscribe to my channel if you haven't yet already. Turn on that bell. And another key risk to pay attention to is how the buy side is thinking about the tail risk. We've got a couple items here. Inflation staying high, global recession, hawkish central bank, systemic credit events, Russia-Ukraine conflict. And here, the biggest tail risk is that inflation stays stubbornly high. And the reason for that is this catalyst will induce a global recession. It will make central banks more hawkish. It could induce a systemic credit event. So inflation staying high has a lot of implications across these other catalysts, along with diminishing everybody's purchasing power, which nobody enjoys. Now, let's take a look at the most crowded trade according to big money. Because a lot of institutional investors think that the Fed is going to remain hawkish, being long the US dollar has been a very popular trade, and it remains the most crowded trade according to this survey. Month over month, we can see that commodities have really fallen out of favor. Oil has come down a lot. So institutional investors don't really think that commodities are are really a crowded trade anymore. It's really the long US dollar trade. Big money over the last 30 days cut their overweight in defensives and they moved into cyclicals. So what are cyclicals? These are the consumer discretionary names in the XLY ETF. Think Tesla, think Amazon, consumer names that are sensitive to the economy. Big money recently repositioned some of their capital away from defensives and into cyclicals. But there is a lot of money on the sidelines, which is why it's a very difficult opinion to form whether we've bottomed or not, because it all comes down to whether inflation has truly peaked or not. We can see that there's a lot of cash sitting on the sidelines. Big money has a lot of cash waiting to be deployed if there is a Fed pivot. However, if there is no Fed pivot, this positioning is going to look pretty intelligent in the next several months. So cash is king and bonds are most underweighted according to this survey here. And sector-wise, healthcare is where most big money capital is parked. Healthcare followed by technology, whereas consumer discretionary is the most underweighted. And in my opinion, this is my opinion, if there is a Fed pivot, if the Fed stops raising rates, doesn't reduce their balance sheet, the sector that will come back the fastest is, in my opinion, the consumer discretionary sector. And the reason for that right now is consumers are very fragile. They're in a very fragile state of mind. And if consumer discretionary spending comes back, this sector is going to get the reap of the rewards upon a Fed pivot, if there is one. At this moment in time, I personally don't think there is one, but if there is, I think consumer discretionary comes back the fastest. You can see here that big money leans conservative in their positioning, and most investors believe in the below trend growth and above trend inflation scenario. I'm in that camp as well. Now, real estate is a heavily overweighted asset class, and weakness in real estate will have tremendous implications on markets because a lot of consumers, they have a lot of their current net worth invested in real estate, invested in their house. And like I said in previous videos, the US right now has strong tappable equity for a lot of households. But the moment that changes, when you combine falling home prices with a lower savings rate and a shrinking checking account balance for most households, that's going to be quite worrisome for the US economy. Now I want to take a moment to talk about our sponsor today, also in the real estate industry, Doorvest. Doorvest is a modern, frictionless way to own income-generating rental homes entirely online. They empower individuals to unlock home ownership, passive income, and equity by simplifying the process and managing an affordable, high-yield rental home. Here's how it works. The company will match your investment criteria with the property, source a qualified resident, and manage the property after you purchase the home, all from the comfort of your own home. So signing up with Doorvest is simple. You fill out a questionnaire, and if everything lines up, you'll start getting matched with investment properties. So let me walk you through the process. Here's how it works. This is their landing page, and you're going to put in your email, your name, and then it's going to tell you the markets that their investment properties are invested in, Atlanta all the way to Oklahoma City. And if those are markets that are interesting to you, press sounds good. You'll also see that the price range of their investment properties are typically between $225,000 to $450,000. So because you're owning the rental property, the minimum down payment is $45,000 to purchase your Doorvest investment home. You'll also get to select the price range that you're interested in for your rental property, the number of bedrooms, bathrooms, and square footage. After you put in that criteria, you can click continue, and then you'll be led to this page where you should put open to all for your investment approach, because that gives you the maximum amount of flexibility related to the properties that they have. And then for how you heard about us, you want to put a Larry in other, and then create your account. And after you create your account, you'll be led to this final page where you can put in promo code Larry, and this will waive the deposit fee. So explore Doorvest today, take advantage of their offer because it expires at the end of September. And with that said, guys, let's get back to the video. Now, a low percentage of big money investors are planning to increase equity exposure. That makes sense according to the fundamental and macro backdrop. And this is the same kind of opinion I've shared inside my investment community. The best thing that we can do at the moment is hold, set your stop losses and trailing stops to follow the market higher. But upon a deeper and larger retracement, risk management is definitely something that we need to practice. Now, a lot of the survey respondents are portfolio managers at mutual funds that have over 1 billion in assets under management, and their timeline is 3 to 6 months out. So all the data that I showed you, this is how people are thinking 3 to 6 months out, and the survey participants are portfolio managers on the buy side. So time will tell whether the market has put in a permanent bottom. I'm siding with the cautious camp. And this doesn't mean we have to sell everything now, but it does mean that you need to have a very prudent strategy in place. There needs to be a criteria with which you use to buy certain companies and their stocks. And it is very risky to buy the most speculative parts of the market, especially if there is no Fed pivot. Now, I have read this out before, but I'm going to say this again. As my investment community continues to grow, as my public audience continues to grow, as the number of friends watching me continues to grow, I just want to talk about a couple reminders. My community is best for long-term investors. And when my friends join my Patreon community, like you, I just want everybody to understand that I'm not interested in day trading, scalping, or any of that stuff. We don't do anything short-term. We don't offer a signal service. We are a research-oriented community. I will guide on levels that I like across my coverage universe. The primary benefit is the quality research that I provide to advance yourself as an investor. And so what I do inside our community is I help our friends identify when risk reward shifts in our favor, to understand why the markets function the way they do, and know how to properly position themselves for the road that lays ahead. And we represent patient capital. We do not rush to make impulsive decisions. So that's the nature of my investment community. And so much of my guidance up until this point has been relatively cautious based on my fundamental macro and valuation work. So heading into August, several key areas that have rallied significantly: Tesla, semis, S&P 500, QQQ. My general opinion and sentiment is that on an impulsive rally, there should definitely be cautiousness surrounded around the market. So I can't necessarily tell our friends inside when to sell, because that's only something that financial advisors can do. But what I can do is give a sentiment reading in terms of how people should be thinking about the market. And we can see here every 2 weeks, I publish a coverage universe research dashboard, which shares my biweekly view and some potential downside and upside ranges. Heading into the second half of August, I rated QQQ, SPY as cautious holds, weak sells. And I provide upper end of the range limits to help people understand when a retracement might happen. But once again, this is not designed for day trading. This is designed for investors who have a long-term view, who might want an option for some tactical strategy. Now, the title of my recent biweekly report inside my community was the following, and it's this. It's that my core opinion at the moment is that once speculative bears capitulate, both them and new bulls will be simultaneously disappointed. And in my opinion, I believe that the S&P 500 in this range of 4,200 to 4,400 is a good place to simply hold or take a cautious approach, because any profitable long positions purchased above current levels is, in my researched opinion, speculative. So the best risk-adjusted way to express a bullish view in this environment is a hold on existing positions. I cannot recommend a stock when the margin of safety is very thin. And that's the situation that we're in the market today. So if you're inside my community and you want to know exactly what to buy, if there are no discounts in the market, if there are no bargains in the market, I cannot provide guidance to buy certain names until I feel very strongly about risk reward. And this allows me to preserve our members' capital and strike when the margin of safety is largest so that your upside potential is also largest. Sometimes the best thing to do is keep waiting and keep researching. So with that said, guys, follow me on Twitter, join my email list down below, follow me on Instagram, links are down below. And this is what I recently said on Twitter, and I sincerely mean this. And what I can promise to all my friends here is this: a deep commitment to high quality research, an attitude of humility. Look, in public, I have to be a little bit more bold versus my private persona. And finally, I have this philosophy of helping my people as much as possible. So I love my work, and I hope you do too. Much love as always, guys. If you enjoyed this video, click the like button, turn on the bell, subscribe. And with that said, thank you to DoorVest for sponsoring today's video, and I will see you guys next time.